Welcome to this month's finance update. I'm Nicole Hoare here at Century 21 Newcastle, and welcome back Ben from Flint Group. Thanks for joining me again, Ben.
Morning Nick, thanks for having us.
So it's been a month.
It has. End of financial year.
Hectic week for you.
Crazy week.
So I suppose we're back just to have a chat to our investors about what's happening in the finance world, but let's get started. What's happening with the cash rate?
There's a few things going on. There's a lot of split opinion on what's going to happen later this year, but I guess the important factors to note is that the RBA have come out explicitly and said that they need to keep inflation on track to return to 2 to 3% mark. At the moment it's sitting at about 4%. So this is CPI inflation, which is closely linked to productivity and sort of gross output from the economy. So what it means for us as investors is that there is the potential for another rate rise later this year. Fortunately, it is sort of in the background at the moment. The things to consider though is productivity is low, so there's still too much money chasing too fewer goods, causing inflation. Unemployment is rising though, it has risen by 1%, which is a massive number. There's a lot of factors at play. There's a lot of economists that think that if they hold rates where they are, it is enough and that inflation will come down. There are glimmers of hope for maybe rate cuts later next year, so end of 2025. I think we'll be on hold for a little while. I think investors would need to prepare for maybe one more rate rise of 0.25%. Again, it's sort of anyone's guess, but reading the commentary from the RBA every time they meet, that's as good as it gets. But they have said inflation is the #1 target. So the only tool they've got is the cash rate. So be prepared for rates to remain where they are or slightly higher for a bit longer.
Yeah, so as an investor, what repayment options do they have?
Yeah, so this is a good one, Nick, especially given that this is an investor-focused update. So investment properties should be structured interest only. Yes, it does depend on the financial position to some extent, but in simplest form, if you've still got a loan on the property where you're living and your investment properties aren't interest only, you could be shortchanging yourself of a tax return and that diminishing each year. I see a lot of investors, unfortunately, that have debt not structured correctly, and that the property that they're holding for future capital growth starts creating them a tax burden rather than a tax refund at the end of the financial year. And then a lot of investors end up selling those properties and selling them out short, where if they were structured correctly, you could be actually getting a tax return out of that property, holding it for longer with the upside of capital growth. And that's the biggest reason that we invest in property. It's for the upside in capital growth. If we can get a little tax refund along the way, or even have it neutrally geared on paper, that would be ideal. So interest only for investment properties if you've got a primary place of residence and a loan attached to it. Even if you don't have a loan attached to it, you could actually look at buying another asset and structuring that in a certain way to be negatively geared on paper, maybe cash flow sort of neutral. And then later on, we could actually look to potentially sell one of those properties, clear out some debt in a lump sum, rather than incrementally paying them off principal and interest and creating that tax burden, which a lot of investors don't like.
Yeah, and that's why it's important to have you to review where you're up to as an individual.
We do a lot of investment strategy.
Yeah. Let's talk about fixed rates. Are they a good idea?
Yeah, so this is another question we're getting asked a lot. It's not sort of static advice. Banks have been changing their fixed rates in the background, even when variable rates haven't really changed too much over the last few months. So there is a big difference between one bank to another in terms of what fixed rates they're offering. My generic advice at the moment wouldn't be to fix. We're too high in the rate cycle, and for a lot of people, if you're fixing at a certain rate that is the same as the variable, or where the variable rate's below, we have to have the variable rate jump the fixed rate for a good period of time to start making our money back on that higher fixed rate, or even that fixed rate that's the same now. So it is important to consider the overall position, the loan to value ratio of the property, how much equity you've got, and also look at what lenders you've got access to make that call. But generally at the moment, there's not really any fixed rates worth swinging at in the residential space.
Yeah. And how are property valuations looking from banks' end?
Yeah, so bank valuations, this is a very, very important one for investors. Typically investors, if they buy one property, they will want to buy 2, 3, 4 plus to get the biggest benefit out of sort of leveraging into property. Just in the last 2 weeks, a couple of examples. There was one place here in Newcastle that was probably worth around 650,000. We had bank valuations come in between 620 and 720. So for this investor, it meant he could pull equity out of that property to then go buy another one. And then there was another one I had that the property was worth probably about 1.5. We had valuations come in at 1 million and 1.78. So between main tier lenders, we're not looking at any bottom tier, we're looking at comparable lenders that compete in the market for business. So this was the difference between this client being able to buy that next property or not. To summarise on bank valuations, if you're trying to access equity or trying to expand your portfolio or even just try to reduce your interest rate, it's important to assess all of your lending options because if you've got more equity in your property with one bank than another, they can offer you a cheaper interest rate, or you've got access to more usable equity for investment.
Great. What about self-managed super funds? What is it and what's the benefit?
Yeah, so a self-managed super fund or an SMSF, it's something that's been quite topical in the last 2 or 3 years. I think that there's a lot of benefits to be had for business owners. There's a lot of benefits to be had for people that don't have borrowing capacity in their personal situation, where they can still go and buy property inside of super to invest. We do a lot of strategy on this. So if you've got a super fund and you're investing in property, you want to make sure that that property is high yielding. So it's got a good rental return. So it's actually paying itself off and also topping up the super fund. Some of the other benefits that can be explained by your accountants are the taxation benefits when you hit pension phase or retirement. The income from that property is tax-free. So there's quite a lot of benefits to it. It also diversifies you. If you've got $500,000, 250, 300 grand, $1 million in super, and you go and buy a property, you can use a portion of your fund to go buy the property. You're then diversified into property, and then probably in conjunction with bonds, listed shares, international, national, that would be managed by your accountant and financial planner. So plenty of benefits inside of SMSF, and it is worth considering because in the last 4 or 5 years there has been a lot of change, meaning that we can now lend up to 70 or 80%, or in some cases even higher in super. Typically it was only 60%, so you needed quite a lot of cash to get into the property itself. And some of the styles of property we've been funding in super have been dual occupancies, residential, so high yielding properties, NDIS properties as well. So it's where the NDIS would have a lease over the property. The rents are a lot higher than your typical rents for a single investor, and also commercial properties too, because if the lease is structured correctly, the tenants typically cover the outgoings. With CPI increases each year, the lease terms are longer. So when you're looking at the yield or the rental return, it's genuinely a net return, which, if you're covering less expenses and you're getting more income, that's the whole benefit of buying property in super.
Yeah, thanks, Ben. So we've got some, you've got some great information for investors this month on the finance.
Yeah, it's been a bit of a mixed bag this week, but I think that at the end of the day, it's all perspective. Investors understanding what options they've got on the table and what could be applicable to their situation. Ultimately, improve your overall financial position, your wealth in property.
Fantastic. Thanks, Ben. Well, we will be back with you next month with another finance update. I'm Nicole Hoare.
Ben Robinson from Flint.
And we'll see you next month.
Thanks, guys.